Credit classification for lenders, portfolio analysis using Python, Part 1. Lenders of all types ought to understand how to evaluate the creditworthiness of their borrowers. In this article, I discuss how a lender can use portfolio data and Python to manage risk and analyze the performance of their portfolio. The article covers various techniques and tools to classify borrowers into different credit categories using Python, and how to evaluate the performance of the models using metrics such as accuracy, F1 score, and confusion matrix. It also provides insights on how to identify high-risk and low-risk segments of the portfolio and how to optimize portfolio performance. Introduction. Credit classification is the process of evaluating a potential borrower's creditworthiness. This is typically done by reviewing the borrower's credit history, including information such as their credit score, payment history, outstanding debts, and income. Based on this information, the lender will assign the borrower a credit classification, which is a label that indicates their level of risk as a borrower. The most common credit classifications include excellent, good, fair, and poor. Lenders use these classifications to determine the interest rate and terms they will offer to the borrower, with lower-risk borrowers typically receiving more favorable terms. Additionally, lenders may also use credit classifications to determine the maximum loan amount they will offer to a borrower. Why is credit classification important? Credit classification is critical for risk management and portfolio analysis because it allows lenders to identify and evaluate potential risks associated with lending money to a particular borrower. By assigning a credit classification to a borrower, a lender can quickly and easily determine the level of risk related to that borrower and make informed decisions about whether or not to extend credit. For risk management, credit classification helps lenders to identify high-risk borrowers and take appropriate steps to mitigate those risks. For example, a lender may require a higher interest rate or collateral from a borrower with a lower credit classification to offset the increased risk. By effectively managing risk, lenders can help to ensure that they are able to recover their loans in the event of default. For portfolio analysis, credit classification allows lenders to evaluate their loan portfolio's overall risk and potential return. By analyzing the credit classifications of their borrowers, lenders can identify areas where they have a higher concentration of risk and take steps to diversify their portfolio. Additionally, lenders can use credit classification to identify trends and patterns in their loan portfolios, which can help them to make more informed decisions about future lending. The most common types of credit classification include prime credit. Borrowers with prime credit are considered the lowest risk borrowers. They typically have high credit scores, a long credit history, and a good track record of making timely payments. They are considered to have the best credit and will have the best interest rate and loan terms. Non-prime credit. Borrowers with non-prime credit are considered higher risk than those with prime credit, but not as high as those with subprime credit. They may have lower credit scores, shorter credit histories, or blemishes on their credit reports. They may have slightly higher interest rates and less favorable loan terms than prime borrowers. Subprime credit. Borrowers with subprime credit are considered high-risk borrowers. They typically have low credit scores, a short credit history, or a history of defaulting on loans. They may have difficulty getting approved for loans and will likely have higher interest rates and less favorable loan terms than prime or non-prime borrowers. Deep subprime credit. Borrowers with deep subprime credit are considered to be the highest risk borrowers. They typically have very low credit scores, a history of multiple defaults or bankruptcies, or a lack of credit history. They may have difficulty getting approved for loans and will likely have the highest interest rates and least favorable loan terms of all borrowers. Below are the main factors that lenders consider when determining a borrower's credit classification. However, they may also consider other factors such as the type of loan, collateral, and the purpose of the loan. Credit score. A credit score is a numerical value that represents an individual's creditworthiness. It is based on information from credit reports, such as payment history, outstanding debts, and credit usage. A high credit score is generally considered to be an indicator of good credit, while a low credit score is an indicator of poor credit. A credit score is one of the most important factors that lenders use to determine a borrower's credit classification. Credit history. Credit history is a record of an individual's credit activity over time. It includes information such as credit accounts, payment history, and credit inquiries. A borrower with a long credit history and a good track record of making payments is generally considered to be a lower risk than a borrower with a short credit history or a history of late payments. Income and employment. Lenders also consider a borrower's income and employment status when determining their credit classification. A borrower with a stable income and a long-term job is generally considered to be a lower risk than a borrower with a lower income or a history of job changes. Debt-to-income ratio. The debt-to-income ratio is a measure of how much of borrower's income is being used to repay debts. A high debt-to-income ratio is generally considered to be a sign of financial stress, which can make a borrower a higher risk. Lenders will consider the debt-to-income ratio of a borrower along with other factors to determine the credit classification. Thank you for watching. Subscribe for more videos.